Good morning, ladies and gentlemen. Special welcome to shareholders and all prospective shareholders. We're here for PSG Group's year-end results for the year ending 28 February 2021. If you have any questions, please lodge them per the instruction on SENS. Then we'll start collating them and we can deal with them following the presentation. So, with the change in our accounting principles, the sum of the parts is the key driver. So we've given a lot more detail recently, as you can see. Just as a whole, if you compare the 2020 results to the 2021 results, the biggest aspect was the unbundling of Capitec. If one had to take it out of the 2020 results, the performance was flat for the past year, and I think all things considered, that's a good result. As we all know, COVID wreaked a bit of havoc in the last year. Since year end, the portfolio has increased by approximately 8%. If we then look at the breakup of the shares, Consult is now our largest holding with 35%. Kira and Alpha each present 18%. Zeder makes 10%. Capitec is now down to 8%. And the other sits at 11%, with the bulk of that being cash. So we're in quite a healthy position as is. Just out of interest, included in the other line, in the other net assets, is the CGT liability on the Capitec shares. It's about 499 million given the Capitec share price as it is today. Just a reminder of where we are today. I think the operating environment remains very tough. We've not come out of COVID in totality. We've got a weak economy and it's been weak for a while. I'll get back to that now. There is significant political uncertainty. The rolling blackouts that do pop up every now and then, and the issues with Eskom, I think has a very negative effect on the economy. The fact that we've got a number of other SOEs that the government struggles to sort out also has an additional negative bearing on the economy. Service delivery as a whole is unreliable, especially if you go to some of the smaller towns in South Africa. It's in a very bad position. We've got aging infrastructure. Here I'm talking about the roads. Again, we go to the rural areas and some of the areas in the country like the Eastern Cape, KwaZulu-Natal, Limpopo. The roads are very bad. Let's get reports of the water infrastructure is really aging. And then the corruption, even though we have the Zondo Commission, we haven't really seen any real action being taken. And then what is a special bugbear for me is the constant mounting red tape that we have. There are a number of issues in the last couple of weeks. We've seen things that want to be introduced through the Companies Act, including mandatory representation of employees on the boards of companies. They want to change the non-binding vote on remuneration to binding votes. But generally, I recently wrote a letter to the JSE. And I'll read you a piece on it, just on remuneration, because I do think the entire approach to remuneration and how it's reported is slightly flawed. So I'll read from the letter. The approach to executive remuneration disclosure is unfortunately flawed in my opinion. It was most probably initially done with some noble ideology, long forgotten now. but it is gaining momentum in the wrong direction. The fact is, CEOs and the management teams and not the board of directors build companies. Here with a very brief example to illustrate my point. 2 CEOs are each given 100 million of capital and instructed to grow the business over a 10-year period. They are incentivized accordingly. They will be entitled to 10% of the value they have created above 200 million. Let's call it the hurdle. CEO 1 increases the value of the company to 300 million, thereby adding 100 million of value above the 200 million hurdle. This CEO accordingly receives 10 million, and shareholder activists, the press, unions, etc. are very happy with the result. CEO 2 increases the value of the company to 10 billion rand, thereby adding 9.8 billion of value above the 200 million hurdle. This CEO accordingly receives 980 million. However, now there is a public outcry from shareholder activists, the press, unions, etc. So we found ourselves in a precarious world where mediocrity in the listed environment is essentially better than embracing the potential value add of the ultimate entrepreneur. In the private equity space, the CEO creating a 10 billion company will be considered a legend by his or her shareholders and will be fully deserving of what she is paid. And nobody, not even the unions, would be upset about this because they won't know about it, with there being no requirement to disclose it in the public domain. Yet more taxes will be paid, the company will be stronger, and the employees will be in a better position. I can go on for a little while. It was a 10-page letter. On PSG Group, we are a significant smaller company following the Capitec unbundling. However, we continue to trade at a significant discount to the sum of the parts, and we started to question the relevance of investment holding companies. On our investee companies, they had significant effort to change the way in which they operated, and we are very proud of all of them. They changed the way they worked very quickly and were able to deliver the service to their clients almost without missing a beat. Most companies also performed admirably, all things considered, and all our investee companies are now well capitalized and focused on growth. So the shift, definitely in the last couple of months, have shifted greatly from trying to sort out the issues, trying to dealing with COVID and all the other related issues, back to growing the businesses. So this leads us to, are there any opportunities that we can take? Just a reminder to shareholder, our main objective remains unchanged. We want to create value for shareholders on a per share basis, and that is quite important. We do not want to grow the largest company, we want to grow the most profitable company on a per share basis. The core way of doing it is to grow the underlying businesses, because that in essence grows our sum of the parts on a per share basis. We will continue to look at selling investments and unbundling further if it is opportune, or using other value-enhancing techniques like buying back shares. We also create value by paying dividends. Just considering that we unbundled Capitec, we've decided not to pay a final dividend. I remind shareholders, whilst Capitec was not allowed to pay a dividend, we paid an ad hoc interim dividend at a half year. It was quite a busy year for PSG. I list here some of the key events, transactions of the last year. The Capitec unbundling was by far the largest transaction undertaken in PSG's history. We unlocked close to 13 billion of value for shareholders. Additionally, after the unbundling, we sold 3.3 million Capitec shares at an average price of just over 1,000 rand per share. We settled all the remaining term debt, comprising, which was a billion rand in total. And Zeder had a number of actions. They sold their stake in Pioneer for 6.4 billion and Quantum Foods for just over 300 million. They also settled all the debt obligations of 1.5 billion, and they paid 2 special dividends, one of 3.9 million and a further 20 cents was announced with their results at year end. They also repurchased a significant amount of their shares during the year. PSG also embarked on a share buyback, and we invested 460 million buying back PSG shares at an average price of close to 55 Rand per share. So I think we've done quite well there, considering that the price is trading close to 70 Rand at the moment. Curro concluded a significant rights issue. It had quite a big effect. The number of shares in issue increased by 45%. We invested just over 1 billion at 8.07 Rand, increasing our stake by 5% to 60%. We also appointed a new CFO, Kobus Loubser, and he is already contributing significantly to the business. And then I've already alluded to it. We've changed the way we account for the business, and we're now seen as an investment entity, which I think would simplify the results for investors going forward. Then on the operating environment and how tough it is, and I think one needs to take cognizance of this if we look at companies' performances, especially if they've got a significant focus in South Africa. I think when one looks at the JSE, sometimes the performance looks okay, but it's driven largely by the Rand hedge companies like Naspers, IBM, InBev, Richmond, and the like. So this graph is annual GDP growth since the inception of PSG. And we can see that the initial years up until the financial crisis, we actually had very, very good growth of 3.6% per year. And then from about 2003 to the financial crisis, we had a fantastic period where the country managed to grow by 5% per annum. It's significantly easier to build businesses and to grow businesses when this is the state of the general economy. We can see that post the financial crisis, growth slowed substantially, and from about 2015 to before the COVID crisis, the growth was substantially lower, hovering below 1% per annum. And then we all know what COVID did. GDP came down 7%. I think the country was saved to a large extent by the resurgence in the commodity prices. So all in all, if you look at it, the economy has shrunk to levels last seen in 2013 if we ignore the effects of inflation. And it does beg the question, do our political leaders have the will to do what is right to pull the country in the right direction? I still don't think we've got the right strategy on COVID. Because the rollout of vaccines a lot quicker. We must quicker to, if another lockdown is required, implement it quicker and get out of it quicker if it's really needed. I, for one, I'm totally and remain against any lockdown of any sort. Then if you look at PSG, and it's irrelevant, our group share price versus the sum of the parts value, we track this on a daily basis. And you can see that here in 2016 and 17, and if you go back in history, for a long while we traded close to sum of the parts, and every now and then we traded in excess of the sum of the parts. But here from early or middle 2017, the gap started opening up, and you can see we're now constantly trading sort of at the 30% plus level in terms of a discount, with the average over the last 12 months being 34%. You can see the liquidity has picked up quite nicely, but I think the market needs to understand that there was a significant amount of trading that happened around the unbundling, as many shareholders rebalanced their portfolios at the end of the day. So my take is the liquidity is likely to come down significantly in the next couple of years. So why are holding companies trading at such material discounts? I think essentially there are 5 reasons. Permanent capital being one of them. I don't think investors like the fact that they give us permanent capital. But I will give shareholders the comfort that our strategy, as I outlined initially, is to create shareholder wealth on a per share basis. I confirmed also that we've never been focused on size, but per share wealth creation. And it's quite important. We are a long-term investor. We are not a permanent investor, as can be seen with the unbundling of the stake in Capitec. Then on the fee cost structure, management does not charge a fee to manage its underlying investments. If you look at the private equity industry, it's normally on a 2 and 20 basis. And even if you compare it to unit trusts out there, the total expense ratio on flexible and equity funds at about 1.5%. It's been a fairly tough year for us, and given that we're smaller post the Capitec unbundling, remember we do make fee income here at a group level. But even all things considered, our head office costs relative to the sum of the parts is only 0.36%, and relative to the market capitalization, because of the discount, is 0.51%. Poor investment decisions by holding companies. I don't think this has a bearing on us. Capitec was an exceptional investment. I've said it often, it's most probably the best company that was started in South Africa, SA-based company over the last 20 years. And just looking at the results presentation last week, I think many investors out there would agree with that sentiment. But out of the portfolio companies, excluding Capitec, significantly outperformed the JSE, delivering returns of 15% plus since February 2020. Been accused of having too many listed entry points. This is a legacy issue and will be very difficult to address in the short term. So what shareholders tell us, they can, given that 83% of the PSG assets are listed, they can essentially go and build their own portfolio. Then maybe the most telling one is the change in tax legislation pertaining to unbundlings. Most investment companies over the years argued, and us included, that we did not have to raise a CGT liability against any of the assets we hold, as we could always unbundle it in the future, like we did with Capitec. But following the Capitec unbundling, there was significant changes to the unbundling legislation. It remains difficult to determine the CGT liability at every given time, because it really has to do with your shareholder base, where you pick up a CGT liability if your shareholders are non-taxpayers. Foreign shareholders create the biggest issue because there's a CGT and a dividend withholding tax provision that you have to make. But at this stage, the PIC is the only shareholder that creates an issue for us. So just to explain the little tax trap, and I'm talking a little bit against my investment model, but it's no point hiding facts from shareholders. So let's say 100 million, you got 100 Rand of capital. If you invested via a holding company and the value increases by 50 Rand and you sell it, CGT is calculated at about 22.4%, and then to redistribute it to shareholders, there is a dividend withholding tax of 20%. If the same shareholder went out directly and bought the assets, they would only pay 18% tax, which yields a 31% higher value for the investor going directly into the share rather than via investment holding company. Obviously, this is a very simplistic example. You can still unbundle the assets and pay a smaller amount of CGT, and it obviously ignores any value adds that investment holding companies can give to shareholders. So in the announcement this morning, we talked about the PSG Financial Services perpetual preference shares. I'll refer to them as PSL prefs. So on this graph, we track the PSG prefs against a group where we calculate the average. They're made up of the Absa, FirstRand, Standard Bank, Invicta, Netcare, Sasfin and Discovery, listed perpetual preference shares. And I've noted sort of 5 key events that have affected the rating of the perpetual preference shares over the years. Initially at the outset, most of them were trading at above 100 Rand or equivalent. I use the word equivalent because Absa issued theirs at 1,000, but I just rebased them to 100. And my take is that to some extent the market didn't understand the product fully. They saw it more of an equity instrument rather than a debt instrument. I think the first time where the investors in these products took a closer look was with the financial crisis. And we can see at that stage, the perpetual pref started dipping below the 100 Rand nominal level. The third issue happened in April 2012, where the country moved from STC, which was charged at 10%, to dividend withholding tax being charged at 15%. I'll get to that in a little while later and to show the effects. But in February, dividend withholding tax increased from 15% to 20%. And then obviously the fifth effect you can see with the COVID-19 crisis, it had an effect where the perpetual prefs as a whole, us as well as the benchmark companies, declined by 20%. So just the effect on the tax legislation. This example which you could use on the PSG prefs, we paid 75% of prime. So assuming prime was 10%, you got a dividend of 7.50 Rand. Now, PSG, like most of the other companies who issued these products, with the change in legislation, we gave the 10% saving that we had where we moved from STC to dividend withholding tax to the holders of the perpetual preference shares. So we increased the rate to 83.3% of prime, where they now have to pay the tax in their own name. If tax was still at 10%, they would have been in exactly the same position, but because it was 15%, to be in the same yield position, the price had to drop to 94 Rand per share. As it increased to 20%, the price to get the same yield as they originally had to drop to 89 Rand per share. So all things equal, Just because of the tax legislation, perpetual preference shares were worse off by 11 Rand per share. So the question always arises, are perpetual preference shares debt or equity from the holder's perspective? As I stated, I think when they were originally issued, many holders viewed them as an equity product with a higher dividend payout ratio. I think it was clear following the financial crisis that the market understood the product better, and prices dropped significantly, increasing the yield. It became clear that the product ranked behind senior debt. And all things equal, the holders of the pref started seeing the product more like sub-debt or mezzanine debt, which should yield higher than senior debt. Then we look at it from the issuer's perspective. I think you can go through the same level of argument, but it's not equity. Again, it's sub-debt or mezzanine debt. There's merely one advantage. If a company has a very bad year and is under severe cash flow constraint, it doesn't have to service this debt, but it's quite late in the day once you don't pay your dividend on the perpetual preference shares, and all other things happening with your company would go in a downward spiral. So quite frankly, you shouldn't be running your investment portfolio that aggressively. The perpetual pref still rank ahead on liquidation. And any senior debt provider, like the case in PSG, would still take cognizance of the perpetual preference shares when they look at the cover ratio, when they calculate the level of debt that you can hold on the balance sheet. So if we look at the recent market performance, you can see that most of the issuers trade in line. FirstRand, Absa and Standard Bank obviously have a slightly higher rating, and hence the a lower yield that they get. We sort of sit in the middle, and the average at 9.5%. I've included the right block, so I'll get to it now, but we're offering to take out the shareholders at 81 Rand per share, so they can effectively sell out of the PSG perpetual preference share and buy back into the bank's prefs and get a significantly higher yield. I think that would be an interesting transaction for most of them. So we've got a proposed repurchase and the listing of the PSL prefs through a scheme of arrangement. The offer price is a clean price of 81. So the prefs increase as the dividend accrues. So it will take us about 3 months, give or take, to conclude the transaction. So you will get the accrued dividend plus 81 Rand. This was approximately a 23% premium to the 65.88 clean price on the 8th of April. We've already got irrevocables and letters of support from shareholders representing 40% of the prefs. So the rationale from the group is we do have surplus cash at the moment, so it's quite a substantial saving. It does create the ability for us to re-gear at significant lower rates should the need require. All of the underlying businesses are well capitalized, so the only investments we do have at the moment is investing for growth. And if it wasn't for the offer, we believe the share price of the PSL prefs were not likely to increase in the foreseeable future. And as I've already stated, it creates an opportunity for the holders to sell out of the PSG prefs and invest in bank prefs, and thereby creating a higher yield for themselves. On the investments, I'm not going to spend a lot of time. All these companies, or the major ones, are listed. You can go and view their detailed results announcements on their websites. It will give you a lot better idea, and it's dealt with in significant more detail. But just on Curro, I'll make a couple of points. Recurring headline earnings decreased by 24%. COVID-19 had a significant negative impact on them. It was especially related to the steep decline in the preschool learner numbers. Although we could provide online learning to primary and high school learners, it's very difficult to do online for preschool learners. The ancillary revenue was also significantly down. This is now aftercare, bus services, all the sport-related activities. And even today, where we're not operating without COVID constraints, this revenue still remains under pressure. Obviously, with COVID and many parents being under pressure, we saw a significant increase in bad debts, and we had to help with fee discounts to assist parents to keep their children in school. And Curro is a fixed cost business, so we weren't able to take out the costs as the number of learners decreased last year. We had a significant negative impact on the margin. There aren't just negatives in terms of COVID. Very proud about the team, how quickly they got their remote and online learning solutions deployed. And we even launched a business called Curro Online, which has seen nice take-up. And when the children returned back to school, we had all the COVID PPE principles in place. And I must say, I'm very proud, and I actually asked them to do me an analysis, and I do hope the wider public takes note. Very few of the learners or teachers or the parents got sick during the school year. I think because of the principles in place, most of the people who were affected got sick during the holiday when the controls aren't there. So I do make an appeal to the education department. Let's never close the schools again. We obviously changed and had innovated digital marketing and branding campaigns, as physically it was more difficult. We had improved grade 12 results, and that was quite pleasing given the school year and how it was hampered. We did the 1.5 billion rights issue. The balance sheet's now very strong, and we can look and focus on growth going forward. In the year ahead, despite terminating contracts with 3,200 learners, we had outstanding balances. We had like-for-like learner growth of about 12%, and the average learner per campus has increased from 800 to 870, and I think this will bode well for the next financial year. We made our first acquisition, St. George's in PE, and we're considering various other acquisitions at the moment. And then we also learned Curro Choice. It's going to provide a wider subject choice at all of our schools. It's a digital delivery of education, and I do think over the next couple of years it will revolutionize the way schooling is delivered. If I go to Consult, they increased their recurring headline earnings per share by 10%. I'm extremely proud of this management team. If one goes and look at what happened at the banks and the insurance company and the financial industry as a whole, almost all of them had significant decreases in earning Some of the companies even made losses. So to have double-digit growth just shows in the power of the model that Francois and his team have built. And all three of the divisions performed good. Maybe the only one lacking is asset management, where the assets under management was down 4%, and we've had net outflows of 5 billion. We've turned it around quite nicely. If you go and look at the slides provided by Francois in his presentation, all of the funds have turned to top quartile in the short term, and we've already seen inflows returning into those funds. So hopefully we've turned the corner on that side. Wealth management was, again, a very strong performance. We increased our assets under management by 20%. What is phenomenal is the fact that we had 14 billion rand of inflows during the last financial year. Then on the insure business, had a fantastic year, increasing the headline earnings by 24%. Gross written premium was up 1%. We did give some discounts to some of our clients, where otherwise the premium would have increased more. And it was especially a good performance by Western National, which managed to increase its underwriting margin from 13.6 to 15.3, and it had an 85% increase in its investment income. Then on Zeder, they had a very big year, selling, as I already mentioned, Pioneer Foods and Quantum Foods. They paid a special dividend of 2.30 rand. And as a whole, the company actually did it right. Most of the business weren't as affected by the lockdowns and were seen as essential services. So Zaad increased its earning by 2%, the logistics groups by 12%. And initially it didn't look so good. If we looked at the financials, sort of April, May, as the management accounts came through, it looked like COVID was going to be a disaster, but that management team turned it around significantly in the last 9 months of the year to deliver exceptional returns. Capespan had a great turnaround, and Tony Fuchs, who's the CEO over there, inherited a business that was in decline. They have restructured over the last 3-4 years, and last year they made a loss of 40 million rand, and they've turned it around to make a profit of 75 million rand, and the business is really set for growth going forward. Kaap Agri delivered earnings growth of 5%, and a significant part of the business was affected by COVID. So I do think that's a great result for the business as a whole. Even AgriVision, our business in Zambia, where we've had significant issues over the last couple of years, turned profitable in the last year. So prospect and strategy, we're going to continue to focus and grow all the existing portfolio companies, but we did release a SENS on 14th of April, following the sale of Pioneer and Quantum. We've had a number of third-party approaches on the remainder of the portfolio. The board is evaluating these approaches, and it's potentially a shift towards looking more aggressively at value unlocking possibilities. So at the moment, Zeder has decided to not pursue share buybacks at the moment. Obviously, as it goes, it takes a long time to conclude transaction, and we want to do it in a responsible manner. But the strategy either way remains the same. It is to create value for shareholders in time. Then if we get to PSG Alpha, this has been the sum of the parts performance over the last 6 years. The spike in 2018 really had to do with the listing of Stadio and the share price run following the listing. It's come back a bit, so the valuation I think is at a more reasonable level at the moment. I'll get to each of these individually, so I'm not going to talk about it there. CA and Sales is a collection of FMCG distribution businesses across Southern Africa and provides a route to market for blue chip investors. It's listed on both the Botswana Exchange and 4AX in South Africa. Now, we've tried in the past to buy businesses in Africa. Obviously, Agrivision is an example of such. But I'm really impressed with what this management team have done. We've obviously got a big base in South Africa, with the biggest operation being in Botswana. But they've been able to build a decent Southern Africa business, and the management team are quite aggressive with their ambitions to build this business. So very happy with this investment. You can see from an earnings perspective how they've managed to grow it over the last couple of years. Earnings was down about 20% in the first half, and management managed to turn it around quite nicely in the second half of the year. A big part of why the earnings wasn't better is because of the liquor sales that were in lockdown with COVID restrictions. But all in all, good investment. Evergreen. So integrated developer, owner and operator of retirement lifestyle villages. We operate under the life right basis, where we own the property and take full responsibility for the care. At this stage, I would say it's been a tough year in terms of growing and expanding the business. But I'm very proud of the management team. They decided very early on that they're going to put their clients first and not grow the business as fast as they possibly can. Our clients obviously are aged people. In terms of COVID, they are the most affected group. So we did everything in our power to keep them safe from the disease, and the incidences that we did have was extremely low, all things considered. So we get income from two places. It's the gains on new developments where we make a normal property developer margin, and then we have fair value gains, and hopefully as the portfolio grows and we resell the portfolio, then we will make additional income. In time, as the villages get bigger, we will hopefully make net income from a levy basis and also from healthcare services. I'm not going to go through this. It's significantly detailed over here. We show it to the market so that everybody can use this to come up with their own valuation. It does make a fair size of our portfolio, so I do think the information is important. And on this slide, you can essentially see the effects of COVID. In 2019, We had 604 units. This increased to 947 units, and we only added 28 units in the last financial year, although we currently have in construction 156 units. Hopefully, as the effects of COVID begin to die down and we aren't in lockdowns, we can hopefully expand the portfolio as the two right-hand columns suggest. Then we go to Stadio. Well, the strategy is to become a credible private higher education business for more than 100,000 students. I think they've done well to date. We've got 35,000 students. Again, they were able to switch quite easily to online delivery. We've got 95 accredited qualification. We operate for 14 existing campuses, and we're building our first mega multi-faculty campus in Centurion. And just to give the spread, there's about 82% of learners doing distance learning and 18% doing on-campus learning. So in the last financial year, we did manage to consolidate most of our brands under the Stadio brand. It's only AFTA that sits separately, and Mill Park. I've already talked about the Greenfield campus in Centurion. If that's successful, we'll roll out the campus in Durbanville. We've got a distance learning logistics center in Kreersdorp. The various new IT systems have been installed, and we continue to accredit new and relevant qualifications. We're quite proud of being the first company to have an online psycho approved PGDA. We've also registered BA Law and various doctorates. This is just a look at how the structure is at the moment. And again, they've shown good growth over the last financial year. On a diluted core earnings basis per share, they were up 18% for the last financial year. Optimi, this is essentially a digital provider of education, and it operates through 4 divisions. The first is the Optimi Home. This is homeschooling or supplementary learning. So we've got 26,000 learners in this category, and there are 2,700 tutors or facilitators which assist these learners. The Optimi Classroom, this is the old ITSE that we merged into the business. They provide e-learning solutions to schools and tertiary institutions. So we currently have more than 1,600 schools using one or other of our core products. And then there are more than 50 other learning institutions that also use the product. We recently bought College SA. These are accredited short courses, and there we have more than 6,000 students. And then MediaWorks, which is Optimi Workplace. And this is where we provide agile education on behalf of organizations. I'm quite proud to say that we got more than 350 organizations that use this product. It's basically an integrated learning model. I'm not going to spend a lot of time on this, but it does use the latest research, technology, and we do give the services associated, but it's all built around integrated education, guidance, content, application, engagement, and formal assessment. And the systems that the team have built is truly phenomenal. Over here we value it on the average PE of the 3 listed peers. We've ignored Kiro's PE for this year, just given that they've had a decrease in earnings and maybe the PE is slightly high. We will bring it into the valuation for the next financial year, but you can see the growth in the recurring earnings the last couple of years has been compounding over 30% per year, and hopefully they can continue as such. Energy Partners, I think they're in the right space. They trying to build energy assets, and our core focus area is solar, refrigeration, steam, and this is backed up by energy intelligence solutions business, which track the asset performance of the utilities and provide service to various large clients, the biggest being Netcare and Pick n Pay. From a valuation perspective, we value it on a 6x multiple for the operating businesses and a 10x multiple on the earnings we get out of the investment business. I think the most important thing on this slide, because this is what we truly want to do, is build a asset business, and you can see over here that we've managed to add significant capital over the last couple of years. In 2017, we had 52 million of assets. Today we got 430. The pipeline looks very strong. If we look at the changes that needs to come on Eskom and generally opening up the energy grid for alternative suppliers, I think there's significant scope for growth for us in this business. On the remaining 4 assets, got SNC, which is a nanofiber-based company. It is a tricky investment, but it's got some great tech in it. The JV with Taiki has been put on hold a little bit with COVID, but hopefully as things open up, it will go better. Carter has really improved the new car purchase experience, and currently today we own the number 1 and 2 Renault dealerships, and hopefully we can grow it. Provest is mining support services. Originally they were fairly affected with COVID, but with the recent increase in the mining space, they are performing significantly better. And Spirit Capital is a leveraged buyout specialist, and they got 5 investments within their portfolio. Thank you very much for listening. If you want more information, as I stated, on any of the underlying companies, many of them have given their own investor presentation, especially the listed one. Please go and find out more of them on their relevant websites. We'll pause now and wait for questions to come in. So we'll take a 1 or 2 minute break, and then the facilitator will ask me questions, and I'll see how best I can answer it for you. Thank you very much.
Good morning, ladies and gentlemen. Thank you, Piet. We may pause at the end again just to allow a minute or so to see whether we've dealt with all the questions. And one or two questions that were posed were answered during the presentation, but we will go through them again just to see, Piet, whether you want to add anything to it. If I can start then with the first question is, can you elaborate on the acquisition plans for Carter? What assets does it intend to acquire and how much funding capacity does it have available for deals?
Thank you very much. Well, Carter essentially would like to buy additional dealerships. Again, as with most things, COVID created a lot of uncertainty. Carter itself doesn't have capital, but we are the major shareholder in Carter. So the funding will come from PSG. We own 76% of it. We have a high quality team over there. So whatever plans we do make, we will bring them along and hopefully build a successful business with them.
Thank you, Piet. Next question, is deploying the cash to buy back the prefs a signal that you are not seeing attractive investment opportunities that should earn a return higher than the interest cost of 83% of prime that you are paying on the prefs?
No, it is not a signal at all. I think, as I alluded to in my presentation, I do think the product from the holder's perspective and the issuer's perspective haven't been the best of late. We do pay a significant high yield on it. And if we do get opportunities, we can refinance quite easily at a significantly lower rate through bank funding.
Thank you. With regard, there's a question with regard to the results, specifically since the Capitec unbundling, PSG Group has steadily reduced its interest in Capitec. Are you looking to sell the entire stake in a certain time frame, or are market conditions playing a larger role in your decision to reduce the holding? That's the first question. There's a follow-up.
I do think I'll just remind shareholders on our stance, and maybe I didn't allude to it during this results presentation, that our strategy is to hold material stakes in companies. So we're not an asset manager which holds 1 or 2% in listed companies. So as market conditions, when they're opportune, we'll look to sell down additional stakes in Capitec.
Thank you. With regard to Zeder, could you comment on whether there is a timeline in which you are working to conclude potential deals? Would the time horizon be closer to 1 or 2 years or more?
It's very difficult to say. Obviously, as most things, if one can conclude a transaction in 1 month, but as I said, the red tape increases and makes it a lot longer to do transactions. But we want to deliver the best result for shareholders, and we've put no time frame on it. We want to extract the maximum value for shareholders, and if it takes even longer than 2 years, then so be it.
Thank you. It seems as though PSG Group's interest in PSG Alpha has increased to 98.3%. Is this a result of the additional amount invested during 2021?
Every time we put new capital into Alpha, when they make investment, it's done at an equity level. The only other shareholders there are management, and they're in many times not in a position to follow a rights issue, but it's always done at a sum of the parts level, so it's fair to the management.
Thank you. With respect to the proposed repurchase of the preference shares, will there be any once-off tax implications at the group level if the prefs are redeemed? Although here is a buyback, but let's read it, buyback.
There's no major taxes payable, maybe STT, but it's not a meaningful amount as a whole. There's no CGT or dividend withholding tax or any of those like.
Thank you. Given the experience with Quantum, with higher bids coming in after the sale by Zeder, I'm not sure why there's hesitation to broadcast which of the Zeder assets are for sale. Now, maybe Piet, I can answer this. The Quantum was not an apples for apples. One must take into consideration that management or the company at Quantum regarded it as a hostile bid, and then a white knight was introduced, and that led to the price going up as a result of buying in the market in order to prevent the takeover. So from that perspective, I don't think we have a similar scenario here. I don't know if you want to add anything.
I can only agree with you, thank you.
The next question is, what percentage preference shares would need to agree to the scheme? Is it 75%? I can answer that it's 75% at a shareholder meeting that need to vote in favor of it. In terms of per share growth and NAV per share accretion, would further share buybacks not have been a better use of cash resources rather than redeeming the preference shares?
As I've stated before, one must view the buyback of the preference share as a refinance, so we can any day replace the debt on the balance sheet. I've already stated that we have repurchased shares in the previous financial year, and we would continue looking at additional share buybacks if it is opportune and the discount is large enough.
Okay, thank you.
The two are mutually exclusive. I don't think one must confuse the perpetual prefs buyback, which is expensive financing, with share buybacks. You can refinance very easily at a significantly lower rate.
Thank you. What level of gearing could the group handle currently?
I would guess if we refinance on a responsible fashion, slightly higher than the value of the current perpetual prefs. I do think, given that we trade at such a material discount, one should have a conservative approach, because if you do get into cash flow issues, you cannot tap the equity market. It is closed. So we have to run, and most investment holding companies have to run their portfolios more conservatively.
Thank you. This question is with regard to Evergreen. For your units that already have life rights agreements, are you seeing downward valuation pressure given the weak property market? I think you had a slide on that in your presentation, but I don't know if you want to elaborate on that.
It's not material negative effect. I think there were very few sales that went through last year. I'm speaking under correction, but I do think we valued the portfolio as a whole down by about 6%. But I'm pretty much sure the raw data on the ground doesn't suggest the reduction 6% in values. Time will tell, and obviously as COVID plays out, I do believe we'll see growth going forward. It's just simply too few sales went through to really draw a firm conclusion on the question being asked.
Good morning. Thank you for the honest and informative webinar as usual. How does PSG Group and the major shareholder view the listing of PSG Group? Does it intend to delist most of its entry points?
I think it's a theoretical question. We don't have an intention because simply the figures involved are too high. So the market can calm down. There's no plans to take either PSG or any of the underlying companies private at this stage in any event. I think my statement comes from, and what I've talked about in terms of listing, is I'm very worried as a whole in the creeping red tape, and that the JSE and other market participants aren't fighting more aggressively to stop the red tape. I mean, I've got various examples on where I believe we've gone so wrong over the last 20 years in terms of dealing with it. And I do think there's an instance where listed companies are at a disadvantage to their private competitors.
Thank you. Next question, could you address your involvement regarding Kiro, Stadio and Zeder since their share price comparatively dropped?
I think the involvement's always the same. It's quite a difficult question to answer. We do spend a significant amount of time with each of the investee companies within the group, constantly trying to help them and assist them to be better companies. There's some instances where you can contribute more than in others. It's especially through the smaller and newer the companies essentially are, the more you can assist them. As company reach a greater level of maturity, your influence and value add generally reduces. So to take an example, at Consult, the interaction has become less and less over the years. We are still involved, but our contribution as the company becomes more and more professional, the contribution from an investment holding company's perspective reduces accordingly.
Thank you. Given all the regulation and the like, would you look to move your business elsewhere, and I presume than South Africa, which is not that easy given that all the businesses are located in South Africa, but Piet?
I think that's 98% of our business is in South Africa. We still believe it's a country with significant opportunities. The management team understand South Africa fundamentally. Again, I will draw reference to many of the other businesses in South Africa who've tried to venture abroad and the difficulty they've experienced in other parts of the country. I do think a big part of our success and our historic success has been as a result of the fact that we've remained true to our expertise and where we have the contacts. So we will remain focused on making quality investments in South Africa.
Thank you. You have said that there are buyers for the underlying assets in Zeder. Would you consider offers at your current carrying value, or could you extract a premium for some of the assets such as Zaad, where there could be a number of interested buyers? Piet, before you answer, maybe I can just say this is actually a Zeder matter to consider, and that is what they have also indicated, but you may comment on it if you like.
Yeah, well, I'll give an obvious answer. So let's say the value is 2 billion for Zaad. I would love a 5 billion offer. I would very much easily accept that if somebody had to offer that.
Yeah, I think it's safe to presume you would prefer a premium. Just 2 seconds. There's one or two questions coming in. You advise what the tax effects are for you to buy back your own pref at a discount to issuance. Is it a gain? I don't think.
No.
I don't think so. Yeah. Dividend. Is PSG not issuing a final dividend for the financial year?
I'll remind shareholders what we said at interims when we unbundled Capitec was that forthwith, just given the scarcity of capital at investment holding companies, and it's very difficult to tap the market should we require, we're going to retain the cash, at least for the short to medium term within the group. And that, given that we've unbundled Capitec, you will essentially be in the same position if you retained your Capitex, as you will get your dividend now directly from Capitec instead of coming via PSG. Whilst Capitec was operating under the board notice from the Prudential Authority and they weren't allowed to pay a dividend, that was the reason behind PSG paying the interim dividend, because that's exactly what we told shareholders we would do. It was in the documentation as well, with the presentation surrounding the unbundling. So for the moment, we've obviously got various plans at the holding company level, and we think it's best to retain the liquidity for the moment.
Thank you, Piet. Please comment on whether additional capital would need to be injected into Evergreen to complete prospective facilities.
Well, there is quite a big list on page in the presentation on where we want to be. It's on page 36. It all depends on the speed of development and how quickly you want to do it and how many of these facilities you want to build at the same time, and do you want to complete the entire village without selling. There are certain advantages in it. We are exploring it, and then we're busy with the project, and perhaps then the shareholders would get together and inject additional capital into the business. But whatever amount it is, it's not going to be significant. I mean, we're not going to put down in one go, put down 5 billion of new facilities. So I think whatever we do decide will be in an orderly fashion. If it's on the normal organic growth path, it's unlikely that additional capital is required. But if we do decide to go slightly more aggressive, then obviously we would need to inject additional capital.
Thank you. Maybe we can just give it 1 minute, and then we will just to see if all the questions have come through. Thank you. We have received no more questions other than has already been covered. So that brings us to the end of the questions, Piet.
From my side, thank you very much to everybody who listened, to all shareholders and prospective shareholders. And I hope we can continue to deliver value for you in the next year and the years to come. All the best and stay safe. Thank you.